After the S&P 500 finally broke out of a trading range, how does the big picture look for stocks now? Before we get into the charts, this week was a good week to pay attention rather than forecast. SPY, or the S&P 500, was up 1.22%, and long-term treasuries, or TLT, up 1.24%. The market model owns both positions. Regular viewers will remember this slide from 3 weeks ago. We said when the market was on the ropes, the major indices had not broken down yet, and prior to having a correction or a new bear market, that would have to happen. It didn't happen, and now we'll see how the charts look as of the close on Friday, May 30th. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We can learn a lot by understanding what markets look like under extreme circumstances. If we can handle extremes, we can handle most anything in between from a risk management perspective. S&P 500 weekly, we use the moving averages to help us discern between volatility to ignore and volatility to respect that requires defensive action. We'll cover these concepts once, and then we can apply them to numerous charts that follow. A full-bore bearish look is when price is below blue and red. Blue is below red, and the slopes are down. It tells us the probability of bad things happening has increased. Conversely, a full-bore bullish look, bottom in 2009 for the S&P 500 weekly, we get a bullish moving average crossover. Now we have blue above red, price above both, and the slopes are up, telling us that the probability of good things happening has increased. How does this chart look today? Looking at the same chart on a larger scale, last week we had a full-bore bullish look for the S&P 500. We still have a full-bore bullish look after the S&P 500 tacked on 23 points in the last 4 trading sessions. This is the look as of the close on Friday, May 30th. Regular viewers know that the CCM market model helps us answer the question, what's a prudent allocation between growth investments such as stocks and conservative investments such as bonds, currencies, or cash. The model uses 5 separate inputs to answer the question. One of them is the CCM correlation model. This is a look or a screenshot of a portion of the model as of the close on Friday, May 30th. This is the S&P 500 here. This 95% tells us for the most part that 95% of the questions being asked, binary and unbiased questions about the S&P 500, are coming back bullish. S&P 500, NASDAQ, broader NYSE composite, and the Dow. The average for those 4 major indices is 91%, telling us that the odds remain in the bull's favor and something needs to change here. If you're new to the model, you may say, well, that's overbought and the market's about to reverse. That's not the way it works. Markets can advance for several weeks or several months with this type of score. The score doesn't tell us anything about what will happen next week. It just tells us that the probability of good things happening remains favorable. Just a quick revisit to the weekly NYSE composite chart that we've been looking at. Gives you a little bit different visual on the bullish breakout. As long as we hold above 10,301, all things being equal, it's a bullish look on the NYSE weekly. Moving quickly here, applying the trend following concepts that we covered on the first chart of the S&P 500, broader NYSE composite, maintaining a full-bore bullish look. Stocks versus bonds, still inside of a consolidation box, but testing the top of the box and currently holding a full-bore bullish look. The Nasdaq broke this trend line, has recaptured a full-bore bullish look as of the close on Friday, May 30th. We noted earlier that both stocks and bonds did well this week. Just in case you're wondering, can stocks and bonds go up simultaneously or in unison for long periods of time? We answer that question in Friday's article. To find it, you can Google short takes, bonds, should stock investors be concerned. You can either find it on Seeking Alpha or our blog, Short Takes. Is it all fun and games for stock investors? No. It's never all fun and games for anybody in the financial markets. The current market lacks conviction still and leadership, although the indices still look healthy. This is risk on stocks divided by risk off bonds. You can see for the most part, it remains in a downtrend. The ratio where it sits as of Friday's close is very, very similar to where it sat in January of this year. So this is a very indecisive look right now. You can see we have a moving average KISS, which is about as indecisive as it gets. Since we own TLT and SPY, we'll basically let the market and the charts decide how we handle them. We're happy to keep TLT if it's performing well and the math allows us to keep it from a rules perspective, and we're happy to back off our equity exposure if that's what the observable evidence tells us to do. 2 weeks ago, we wrote an article, or roughly a week ago, Friday, that said nothing said that small caps couldn't regain their footing. They're trying to do that. IWM was up almost 0.8%. You can see we do have a full-bore bullish look. It's not very convincing, but they're trying to make a turn, and this is trying to hold. The longer it can hold above this, the better for stock bulls. The bulls would prefer this look to morph into something more like this with some white space in between. We noted several weeks ago on this chart of the Nasdaq weekly that the probability of the correction being over, the odds would increase for the bulls if Williams %R could recapture the center line at -50. It doesn't tell us what will happen next week. It just tells us the odds of good things happening are better here than they were here. Being successful in the markets is a two-pronged approach, meaning you have to find positions that have a high probability of going up, and you need to avoid positions that have a high probability of underperforming or going down. We showed this chart of GLD earlier in the year saying we were trying to be patient because we never had a bullish moving average crossover on this chart here. It has helped us. We've avoided gold. This week, that helped a lot. GLD trailed SPY by over 4% this week. The same thing can be said for TLT. One of the weakest looking charts tracked by the market model is the credit markets JNK risk on relative to TLT risk off. You can see it's in a full bore bearish look. All things being equal, stock bulls would prefer to see a full bore bullish look. This is the bad news. The good news is JNK TLT carries a relatively low weight in the market model because of its predictive validity relative to the other inputs. This ratio is helpful. It's just not as helpful as many of the other inputs in the market model. The market model tracks observable, binary, and unbiased evidence. If we zoom in on the weekly chart of IWM, we can see that the slopes of the moving averages were down here and price was below both. We can see some observable improvement. Slope of the blue is turning back up. Slope of the red is turning back up. prices back above both moving averages. If you're a stock market bull, you want this look to morph into something more like this. And if you're a bear, you prefer this look. Regular viewers know that the probability of good things happening on the weekly S&P 500 chart improve when we move into overbought territory. Good things happen. Overbought territory, probability of good things happening increases. We closed in overbought territory. Until something changes, this will check bullish boxes in the CCM market model. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.